Hi, my name is Thejes Kumar, and I'll be talking about the container shipping industry in this presentation. So, what's currently happening right now in the sector is that rising rates have had many feeling a bit hopeful, but in this presentation, we'll be seeing whether the optimism will be warranted in the long term or not, and we'll also need to consider many factors going forward to see whether the positive trends outweigh the negative or vice versa. So over the last few months, the container ship sector has witnessed an uptrend in rates. Several factors have contributed to this, but recent developments may be shifting the tide. So first we'll have a look at the positive factors. So it's been noted that the container trade has a strong positive correlation with the US personal consumption over the past 10 years. And as you can see, the personal consumption is clearly improving in this graph. Also, the ECB has announced that it will inject up to 1 trillion euros into the economy. The IMF is also expecting the Eurozone growth to improve. Lower oil prices, further monetary easing, euro depreciation, and also increasing consumer confidence in the Eurozone are other positive factors for this industry. The strengthening dollar should also bode well for US consumption of overseas products, and also containerized shipments into the USA are expected to rise in the first half of 2015. The oversupply of vessels which have troubled the markets over the past few years, that trend may be coming to an end. As you can see in this graph, a thinning order book in the small and medium container ship sizes. The negative factors, China is responsible for 35% of world container ship demand growth. However, China has recently experienced its heaviest downturn in exports in several years, and this can be attributed to these factors. Weakening currencies in two of its major export markets, the Eurozone and Japan. So the euro, which was as of last year equivalent to 8.6 yuan, has lost 23% in 1 year, and the yen has also similarly declined by 15%. So the result is that exports in China and also imports have both dropped. The bunker costs actually make up a significant 22% of the container operators' cost profile. So the recent reduction in their costs have provided them with some financial breathing room. However, a prolonged reduction may actually have a limited impact on their overall performance for two reasons. The first being that shippers will likely capitalize on it as an opportunity to continue pressurizing them to reduce their already rock bottom freight rates, thereby siphoning off the benefits of reduced fuel prices. Also, the benefits of slow steaming will continue to narrow, and this will cause carriers to speed up the vessels to increase throughput and revenue. So it will ultimately have a negative effect because it will further increase capacity in a market that's already oversupplied. So there are a few trends which companies in this industry, which can be seen in companies in this industry. The first is they're starting to focus on their core business activities. So cash operations have improved by 20% since 2013, and the total debt has reduced by $107 billion to $91 billion. Also, carriers are investing in new larger vehicles, more so in the east-west volume trades. The second trend is that they're continuing to focus on customer and service profitability as compared previously they were focusing on just cost reduction initiatives. So now they're focusing specifically on route profitability, selective customer targeting, and smarter allocation of resources. So the conclusion being, the shipping industry continues to struggle financially, and there's no clear end in sight, and it also continues to face significant headwinds in terms of supply and demand imbalances. And also the recent decline in fuel prices might give them some breathing room, but it won't last long. And many carriers are doing the right thing by shedding their peripheral assets, and they should continue to do this by matching this with an in-depth understanding of profitability at the trade route and customer levels. We'll be looking at one specific company, Shipping Corporation of India. So we can see the Indian economy has grown by 7.3% as compared to 6.9%, and exports and imports. However, the exports and imports have both fallen along with the total cargo movement. So this company has been around for 50 years, and it's an end-to-end player covering all aspects of the industry. It owns and operates 38% of Indian tonnage as well. So the challenges faced by it in the past is it has incurred 70,000 million rupees as capital expenditure to acquire new vessels. Unfortunately, the order placed by it in 2007-08 were when freight charges and asset prices were at their peak. So this has resulted in lower margins and also low EBITDA, and the debt equity ratio has increased substantially by 0.3 in 2008 to 0.9 in 2015. The profits, however, have increased but this can be due to resentment of vessels which have led the other income to increase by roughly 1 billion rupees, and this has also caused depreciation to decrease. So the profit is not just due to operations but also due to this. Also, we can see the creditor and debtor days have both reduced, which is not a good sign. So the future strategies which I would recommend if I were a major shareholder is to improve the operational efficiency, to increase cash flow by building further reserves and assets, and to improve the debtor and creditor days, to implement an integrated management system. A SAP ERP is already on its way. This is to ensure that all processes are automated and digitized for a complete end-to-end view, and also to concentrate on profitability of a single container through its journey, and also to make sure the data is consistent, accurate and complete, and also to make use of big data analytics, and to also move away from low margin and non-strategic customers, goods and routes, and to initiate due diligence by looking at the possibility of shedding of non-core. For example, the dry bulk segment, which the management themselves have said that have quoted, I quote, very few profitable trades this year and expect the trend to continue. They can also look at refinancing their long-term loan. I would also advise them to monitor the Chinese market to confirm its economic stability and immediately look to acquire mid-sized companies, and also look at fleet expansion, but with the focus on profitable route and customer segment.